Yeah, it looks like Martell's joining as well.
Yeah, good.
Yeah, it looks like Martell's joining as well.
Okay. Mm. Is Al with us?
No, Martell has joined.
Hey, everyone.
Oh, okay, great.
And then Al, let me get Al in here. So we have enough to get started.
Hey, Donna.
Hi, hello.
Hello, everybody.
Hello.
Hello.
Okay. Did you want Martell to open up the meeting, or Al? Or?
Either.
Okay,
or
Martell or
both.
Al, either one of you all can open up the meeting. We're ready to roll.
We're gonna call this meeting to order on today, which is May 19th, 2022. The financial committee meeting. We're gonna start right now. Can I get a roll call, right?
All right.
Sounds good, Al.
Angela Banks,
Here.
Christina Bennett, Lewis Cross,
Present.
Sheila Goodwin. I think she's going to be running late. Donna Jones,
Here.
Yvette Levy, Martell Mann,
Here.
Bobby Richardson,
Present.
Albert Sanders,
Present.
Justin Stein, and Doris Walker.
Here.
All right. So we have 7, so we have enough for a quorum.
Okay.
So Jeff or Gwilda, I'm not sure where you wanna start.
Okay, all right, well, we'll start, I guess with the first quarter performance report. Sue, if you want to bring that up on the screen,
Okay, will do.
and we'll weave into the discussion regarding exponent fixed income in that discussion. Okay, if you want to turn to the next page, Jeff is going to do the economic overview, and then I will get into the performance of the, starting right here, I'll get the performance of the managers after Jeff goes to the economic overview.
Great. So I'll have you flip forward one more just so we don't have to sit here and read and look at a bunch of white space. So, but in a nutshell, here's the performance as of the end of the quarter. And you can see in the 2 charts, the top box is the quarterly performance of the major asset classes right below the 1-year period. And you can see from the top chart in the quarter, a lot of big negative bars. So, and I'll talk a little bit about that in a moment as to really where that's coming from. And you can see below, at least as of the end of March, still had a few areas of the market, in particular, those larger cap stocks, which people look at as being a little bit safer, still holding on to their positive returns. But as we get to the April flash and talk about where we've been since March 31, unfortunately, a lot of that positive that you've seen for the 12-month period has gone away. So we're now looking at a 12-month period that's probably flat to slightly negative in most spots. So that has been eroded. But the real big ticket items that we're seeing in the markets, and they're pretty much interrelated, are inflation and the Federal Reserve and what they're doing with interest rates. So again, very much interrelated. So if just looking at the inflation figures and how that plays into everything we're seeing, things are very expensive right now. So that's really what the inflation is telling us. I mean, we've all been to the gas pump recently, and we know that it's a lot of money to fill up our tanks now. And when we go to the grocery store, all of our regular food that we've generally been buying, if we like to get some steaks and you know, good things like that, it's a lot more expensive. So, you know, ultimately what happens when things get too expensive? Well, consumers start to tighten the belt. So if we were going to take a vacation this summer and drive somewhere, maybe we're thinking about not doing that. And certainly things like high fuel prices also factor into airplane fuel. So our plane tickets for going places are, you know, usually when it's summer, so it's extremely hot down in Florida, but I'm actually looking to go down there because my mother lives down there. And usually I can get a better deal for a summer plane ticket, but right now they're expensive. So, and again, a lot of that just has to do with what we've seen in these fuel prices and inflation for everything else. So that's one thing that's hitting the market, is just the expectation that consumers are going to pull back their spending, and they already have because of this inflation. And there's also a second part to this now, and that's what the Federal Reserve is doing in reaction to that. So in normal environments where inflation is running higher, but not so hot as it is right now, the Federal Reserve has these mechanisms in place where they can make interest rates go higher or lower, depending on what the market's doing, and to sort of regulate the economy. And so what does higher interest rates do? Well, it makes it a little more expensive for businesses to borrow and for consumers to borrow, and so they'll pull back their spending habits. So again, in normal environments, that kind of keeps things in check. Where the job of the Federal Reserve and what they do with interest rates becomes a lot trickier is like an environment we have now, and we just haven't seen in quite a while. And that's a very high inflation number, but also an economy that's sort of riding the fence. And right now, everyone's very concerned that we already saw the Federal Reserve come in and raise those interest rates by 0.5%, which is a pretty big raise. If you think about the last time the Federal Reserve was doing something like this, we'd have to go back to 2018, and they were raising interest rates by 0.25% increments.
Mhm.
So a little bit more measured, but things were operating a bit normally. And then boom, COVID hit, and they said, we've got to stimulate the economy. So let's pull it all back to near zero again. Let's make lending very easy for people, and let's stimulate the economy. So that's sort of the process that we've been through. But now we're at unprecedented levels. And again, this is where it's a real trick for the Fed, is that the inflation numbers we're seeing they're not solely due to the fact that everybody just wants to buy everything out there, and there's the demand is very huge. The other part of that is the supply portion, and that's because we have a certain portion of the population that is still in COVID mode, and is still sort of stretching out some of that money that came in from stimulus and other things, whether they moved in with their parents or however they were able to make ends meet through COVID. Some folks are still stretching that out, and so that's kept a certain percentage of people out of the workforce, and that's impacted supply. So there's not as many people out there to make chips that go into cars and computers and other widgets that people buy and sell. And so when there's not enough supply, but demand is sort of at the same level, people that sell the widgets raise their prices. So that's a very big portion of that inflation number that we're seeing right now. And again, the real trick for the Fed at this point is they want to get interest rates to a normal level, and they want to bring inflation back to where their target is. And again, let's think about how far we are away from their target. The Fed wants to see long-term inflation at around 2%. So right now, at our peak, we were at 8.5%. last reading. It came down a little bit to 8.3, and we expect it's going to continue to come down, but we're still a far ways off. So again, there's a balancing act that has to be figured out with respect to getting us closer to that 2%, but without stalling the economy. And that's really what we sort of sit in danger of right now. And let's talk about recession, because that's the other headline you're probably seeing a lot about right now. And for good reason that we're seeing that. So a recession by definition, and there's all sorts of qualifiers we can put on this, but is 2 back-to-back quarters of economic contraction. So first quarter, we already saw the economy contract. So that we already have 1 quarter of that. And now we have the Fed still saying we're probably going to raise interest rates by 2 more half points in fairly short order here. And if they stay on that path, that could very rapidly push us into a situation where just prices are high, it's hard to borrow money, and consumers and businesses are going to tighten the belt real quick. So I think where we stand right now, there's a very high likelihood that we will see more contraction in the second quarter. So technically we'll be in recession, but when we look at historical recessions, we always have to take a look at what's behind them. So probably the last recession we saw was probably more of a picture of unemployment. So we had higher unemployment, and that's why people weren't spending. Whereas this one, the unemployment numbers are fair. I mean, with the exception of we still know there's a certain population that doesn't get counted in those unemployment figures because they've just come out of the workforce. But nonetheless, the employment number looks pretty decent today. So why is the economy contracting? Well, again, it's because people are expecting inflation might stay a little bit higher. Things are expensive, and they don't want to erode savings. So tightening up the belt, not spending as much. So those are things that can certainly make a recession be shorter, because when prices start to come in, well, the consumer is still working, has money that they've saved, but they just haven't been spending. But once things get cheaper, they will decide they want to come back into the market. So things like that can make a recession a little bit shorter. But again, we're not fully positive at this point what those factors are going to look like. And again, things like the unemployment numbers can change. And we've already heard that some of the larger companies who have been out trying to hire, no one's at the level where they've said, well, now we're going to start laying people off. We're certainly not there, but we have seen some larger companies say, well, let's start to pull back a lot of the hiring and the job offerings that we have. So that, again, the amount of jobs out there are still pretty large. So on a relative basis, we're still very good on the jobs front. But we are at least starting to hear that tone of companies say, maybe we won't be hiring as much. And again, these are things that can kind of change pretty quick. And as we've looked over the past couple of days, we now have earnings coming out, and we're seeing companies, even the ones that should be doing well in these types of periods, because they're what we call a staple. So things that people really need. So a Walmart and a Target and the stores and all the products that people need for everyday living. Even some of those earnings have been coming in a little lower than expected. So all of those things say we might continue to see some more volatility. And again, certainly you can see where this all started on this chart back in the quarter, and has really continued to the current day, through April and May so far. So those have really been the big issues that have been out in the market. Again, there's some things on the fringe as well. We're seeing these continued COVID lockdowns in China. So that's been a big impact on the overall global economy and the emerging markets in particular. So that's something. And certainly as we talk about the COVID overhang, there's always the concern here in this country that are the numbers going to pick up again. And we have seen some instances of COVID picking up, but I think what we have seen by and large is that the majority of the population has been vaccinated, and due to that, it's sort of limited the impact of COVID to that of a regular flu. So hospitalizations and deaths are a lot lower than where we were a year ago or 2 years ago. So the COVID factor is probably, at least domestically here in the United States, not as big of a factor. But again, there is some overhang there. And then just other, as far as the typical political things that we see on a day-to-day basis, and certainly a Roe v. Wade type thing. And again, should markets be reacting or trading on something like that? Who knows? But it's news, and you certainly see it thrown into the mix on a day-to-day basis of, well, this is now being discussed, and so markets are going to react one way or another to it. So just a lot of news items that continue to hang out there that tell us we're probably going to continue to see this elevated volatility for quite a while. So, and again, once we get to the April report, we'll see another chart, and we can talk a little bit about some trends, because we have seen some things reversing, in particular, those stocks that seem more safe and have been very much out of favor the past couple of years, like the value stocks are leading in this type of environment. And actually, what we wouldn't expect to be doing as well as they have for the past couple of weeks would be the small caps. So again, those are the riskier area of the market, and we would think people would still be very much avoiding them. And again, there is net selling there, but the past several days we've actually seen the small caps leading everything else. And I think that's just going to be solely due to the fact that they've been so oversold for the past couple of years now, or just out of favor, that the valuations are very attractive, and a lot of buyers are starting to come back in. But I guess if there's anything, and again, we'll get into the portfolio structure and asset allocation, and I think we're going to be, I'll be telling you something here that I think everybody knows, but certainly in this type of environment, what we don't recommend is trying to time the markets. So we're not going to come in here and say, well, we think the markets might not be good for the next couple of quarters, so our recommendation is to pull everything off and put it into cash. So we don't recommend that, because that's just not a good long-term policy for a pension fund. So I know it's always hard when we see this kind of volatility to say, well, our recommendation is more or less to not do anything and to stay the course. And that's always the toughest thing to do, but it's the right thing to do. And as part of that, it's not just staying the course, but it's also rebalancing. And again, that was, if you think about the recommendations that we proposed at the last meeting, that there was a good deal of that rebalancing in there that said we've got some areas of the market where we've been a little bit underweight relative to policy, a little bit overweight. So let's do some rebalancing. So again, that's always healthy. And as part of this process, and as part of the system's investment policy, again, something we always recommend. So if the markets do continue to sell off, which we hope that's going to be limited, but when the markets are selling off and we're below those targets that Gwilda is going to talk about in a second, that our process is we always want to be rebalancing back upwards towards those targets. Again, it seems counterintuitive. It's always hard to say, well, the markets are down, why are we adding to it? But there is a rationale behind that, and there is long-term studies that just show us if we are disciplined in our rebalancing, and we buy when things are low and we sell when things are high, that actually works out for us on a relative basis over time. That helps us continue to stay in line with our policy and outperform indices and outperform peers that don't do that peers that are trying to time the markets, and that is always hard to do. And we have exhibits that we can share with the committee in the future that really point to that in particular, when we have these types of market sell-offs, it's probably always easiest to say, okay, the market's selling off, it's real easy to get out of the markets. But the hardest thing is always when to get back in. And really what we've seen historically from these types of market sell-offs is the recoveries are in very short periods of time. So you can basically gain an entire year's worth of recovery in a handful of days. And if you're trying to time the markets and you miss those specific days, while you get back into the market, ultimately, if you miss the big up days, you've missed a lot of that recapture. So again, this is why we rebalance. This is why we stick to a long-term policy over time. So I will pause with that. Again, I know we have lots of pages on the market in here, but our intention today was not to cover a lot of this, but hopefully this just gives you a general overview of some of the volatility that we have seen in the markets and really what's been causing that, and really the expectation that it's hard to tell at this point when that stops and things start going in the right direction, but certainly not knowing that or not having that crystal ball is why we point to continuing to stay the course with this policy. And again, that's really going to be our primary defense tool, again, along with what we have in place in the portfolio, which is a great amount of diversification. And again, it's hard to see in short time periods like this when everything's down, when our equity managers are not doing good, our fixed income managers are not doing good. It's kind of hard to see, but and again, where these reports are always going to play catch up a little bit too, is that we have this portion of the portfolio in alternatives that, number one, are sort of on a lag and play catch up to us. But number two, we know some of those things are actually doing pretty well in this market. So we have those diversifiers and those downside risk protectors in the portfolio in the form of these alternatives. So again, having all these mechanisms in place that we're not fully sidestepping this volatility that's in the market, but we're doing a pretty good job of protecting and minimizing, and also setting ourselves up to continue to have a good long-term return for the system. I'll pause. Okay. If there's no questions, Golda, if you want to jump over to the next section.
If you move over to page 1, keep going, 12. Right there. Okay, as you can see here, we've shown you this page before. All the segments, with the exception of large cap equity, are within the ranges. That gray bar represents the range that is allowable, the minimum and maximum range for each of the segments. As you can see, that red upside down triangle shows that large cap equity is off a bit. If you look down at the corresponding numbers below, you'll see that the target allocation is 13, but we're actually at 16, so it's overweighted by 3%. And the two areas that have the most out of range are international equity and emerging markets equity, not surprisingly with what we have seen and experienced in the international markets over time. And then the one that we always are trying to, fixed income we've also is also out of range, but not significantly so. And the area where we're always playing catch up is in the alternatives area, because you have distributions coming in. So it's hard to keep that alternatives number up. If you'll turn to the next page, this is the market value of the fund as of December 31st and as of March 31st. As you can see, with the negative returns in the market, you see a reduction in market value from December from $966.9 million down to $903.3 million. And that's reflective of the underperformance or the negative performance in various segments of the portfolio. Going on to the next page. Page 14 is the fees outline, but more importantly, let's go to the next page. The next one. This is the one where we actually show where your current managers are as far as fees are concerned, and we will keep this in the quarterly reports and update it once a year to show you how you look versus other managers that managing that style. You see 3 managers where they are slightly above the median annual fee, those being Westfield, Systematic, and Lazard EMD. Westfield and Systematic, not hugely so, about 3 or 4 basis points over. Your largest differential is in the Lazard EMD, where the median peer group is 60 basis points and theirs is 75. Okay, moving on. This is the minority brokerage report, and we have been asked, along with Sue, to get in touch with the managers within the portfolio to speak with them regarding their brokerage. As outlined in the policy, there are different goals for different portions of the market. For domestic equity, you see the commission goal per the policy is 33%. And you see these three managers, Edgar Lomax, Systematic, and Westfield, have all met the year to date, their minority brokerage goal, NWDBE goal. The two managers that have not met it are TCW and Intech. They both sent back responses to Sue and copied Jeff and I regarding them not meeting that. TCW basically referenced the fact that they do block trading. So it makes them very difficult for them to meet the minimum MWDBE keeping in mind their best execution. They sent a letter, which I'm sure Sue may or may not have shared with you. We can share with you that letter or response back. And Intech is the other domestic equity manager. They're a large cap growth manager. Basically said they have an internal list of managers that meet their standards, and that a lot of the managers that we have listed on a minority brokerage list are not on there. They do have a minority manager, Gooseman and Company. I don't believe they're on the list for St. Louis Public Schools, but they have allocated dollars or commissions to them at 15% year to date. So they're both either, well, TCW has not allocated any, and Intag has allocated to a manager that is not on the list. The next area, these are the managers who actually are in, these managers are actually separate account managers here. We don't include the funds, which is a different story. You can't really allocate within a fund. But Causeway here, as you can see, they met the goal for international. The goal is 10%. They're at 29. In the fixed income area, you see Earnest Partners and Exponents have both met the brokerage goal in fixed income, which is 10% at 47 and 18. And Exponents in the global equity area has met the goal or exceeded the goal 23% versus 10%. So we have a mixed bag, but all the managers have been notified, are reminded, I should say not notified, but reminded of the MWDBE commission goal per what is outlined in your investment policy document. And we will continue to monitor this over the course of the year and look for improvement and also buy-in from some of the managers that are not reporting. Any questions before we move on? Okay, move forward to page 17, 18. Okay, this shows the market value, beginning and ending market value. If you go to the next page, so this will show the totals. Okay, if you see here, you can see here the market value as of the beginning of the year. I mentioned the dollar figure there, the 966,973,314. Then you show the contributions and distributions during the course of the quarter. Expenses, capital gains and losses. As you can see, the largest number there is capital gains and losses at 44,730,387 to end your market value at the end of March at $903,316,604. That shows you the cash flows from January through March of this year. Moving forward, let's go to, keep going forward, Sue, to page 21. We get into the fund performance. It's up, just, okay, there we go. Okay, well, this is the pure universe, basically, of funds who are less than $1 billion in size. As you can see here, the return for the total fund was negative 4.40, below the policy index, but ranking better than the average fund of this size at 45th, so above the median. The longer term numbers are a little bit more challenged. 1 year is below the median. 2-year is right around median. The longer term number is a little bit more challenged versus other funds that look like you, but we're coming back, as you can see here. So you're above median for the first quarter of 2022. Going on to page 23. Go to page 23. Okay, this is where we get into the meat of the returns for all portions of the account. As you can see here, as I mentioned, for the quarter return of the total fund with negative 4.40 versus the allocation index negative 3.04, ranking 45th. If you look down the page, you see your total domestic equity segment had a difficult quarter, and you will see that that's owing more to the large cap growth managers. As you can see, domestic equity had a return of negative 6.58, ranking 61st. And this is versus the Russell 3000, which encompasses both large, mid cap, and small cap stocks. If you look over the course of time for this, for the domestic equity segment, you see that there's been some challenges with respect to them beating the Russell 3000 collectively. As you can see here, it's as a whole, the fund has not kept up with the Russell 3000 on the longer time periods here. In the large cap equity segment, as you can see here, large cap core, which is an index, and index doing exactly what it's supposed to do. It mirrors the return of the S&P 500 at a negative 4.59, right on top of the index return of a negative 4.6, and it's right around median. So what this is showing you here for this index fund actually is a very efficient use of your large cap dollars. And that if you look across the board, if you looked at other active managers, you can see the index fund is actually done better than your active core manager. So this is a very good use of dollars in that particular core space. In the other, going down to the bottom of the page, Edgar Lomax is your large cap value manager. Edgar Lomax had experienced some difficulty, and actually they're on watch now. But as you can see, they've been outperforming in this quarter. You got a positive number in what has been a very negative quarter at a return of 1.52 and ranking 26th amongst their peers. And looking at the index that they manage against is a negative 0.74. So this manager has added value over and above, which is what you want active managers to do. And if you look at over the past year, this manager also has added a significant amount of value over the Russell 1000 value at 15% versus 11.67, and ranking better than 70% of the other managers in their peer group. As I mentioned, they have had some difficulty longer term, but what's good to see is they're coming back. Turn to the next page, Sue. Here are your two large cap growth managers. As you can see here, Intech and TCW. Growth has in the past had, if you look at these long-term numbers, has been very robust long-term. We're starting to see a reversal in that style. And as you can see here, both Intech and TCW experienced very difficult quarters this time, negative 13.93 for Intech and a negative 13.95 for TCW in the first quarter of the year. TCW's security selection hurt them, especially in the information technology, healthcare, and industrial sectors. Intech in communication services, consumer discretionary, consumer staples, healthcare, and in real estate. All basically stock selection things did not help them. It actually hurt them in their performance. And as you can see here, looking also, if you look across here, you can see that these numbers, these are peer group rankings. And if you look at the Russell 1000 growth, you can see that these managers are having a difficult time beating this index. It's been a very difficult index to beat on a long-term basis because it has been very robust over time. So we'll keep an eye on these managers and look for improvement, because you are paying for active management, and the expectation is over time that they will not only beat the index, but also rank better versus other managers. And they, the numbers here are not holding up versus other managers, with the exception of this 10-year time period for Intect and for the 5-year time period for TCW. Going down the page is your small cap managers, which are also part of that Russell 3000 domestic equity segment. As you can see here on a relative basis, Westfield and DFW Microcap actually held up well in a very difficult market. Westfield added value over and above the Russell 2000 growth. They represent your small cap growth manager and actually ranked 39th above the median manager during the quarter. And the longer term numbers are somewhat mixed, but as you can see here, they've added significant value in a difficult time period versus that Russell 2000 growth. And look at the 3-year number, very compelling versus the Russell 2000 growth at 16.86 versus 9.88. Since inception, albeit they're not as strong versus their peer group, they've added significant value over and above the benchmark, 10.02 versus 6.54. If you look at Systematic, which is your value manager in that space, they had a more difficult time in the first quarter of the year with a return of negative 4.94, underperforming that Russell 2000 value index at a negative 2.4. In the 1-year number, right around the Russell 2000 value, but below other small cap value managers. Longer term, though, if you look at this, is interesting in that the manager has beat the Russell 2000 value, but in this 3-year period, they're below the median, but they have both beat the, on a long-term basis, which is what you want to look at with managers, they beat their peer group median, and they have added value over and above the Russell 2000 value. So Systematic, albeit having some short-term weakness, they're doing fine. DFA Microcap, which is a combination of their benchmark is a combination of small cap and microcap stocks. On a relative basis, albeit negative, they added value over and above this benchmark, negative 4.47 versus a negative 7.56, and ranked well amongst peers at 31. Over the past year, you see that strength also with a positive return of 5.48 versus an index return of negative 8.40. So they not only beat their benchmark, but they also rank well amongst other managers that manage like them. What's interesting here is longer term, this manager has added value over and above their index, significant over and above their index, but they have not kept up with other managers that manage in this style on a longer term basis. Any questions on domestic equity before we move over to your international managers? Okay. All righty. So here we're showing at the bottom of this page, you have Fidelity and Causeway. As you can see here, Fidelity has actually underperformed the EFA, but the international, which is the developed portion of the international markets, underperformed negative 8.6 versus negative 5.91. But looking at how their other managers that manage in this style, they actually done better than the median manager. They've had difficulty, as you can see here, over the past year, beating the index, but keeping up with other managers that manage like them. Longer term, this is interesting here. Longer term, you can see Fidelity has actually beat the index long term, but they don't rank as well versus other managers. So basically what we're saying here, yeah, they're doing the job, but there are other managers out there that could possibly do better on a longer term basis versus in this particular style. Causeway is the other developed manager. And as you can see here, Causeway protected on the downside in the first quarter with a negative 4.96 versus a negative 5.91 for the index, slightly below the median manager at 56. If you look at them longer term, This mid-period, there is some difficulty versus the index as well as versus their peers. And we see this continuing on a longer term. But if you look at the longest period we have here, you've had them since 2005. They're slightly above the index at 5.98 versus 5.19, but they're still below the median of the peers in the long term since inception of you employing this manager. If you move over to the next page, we're going to go into the emerging markets. Here you've got DFA and Invesco. And this is the portion of the market that we were concerned about with respect to what's going on with Russia, Ukraine. As you know, those markets are still not open. So there has been a write down by especially in Invesco emerging markets, which probably was the manager that had the most exposure. As you can see that here, and that's principally the reason for their returns that you're seeing exhibited here. But if you look at DFA, it's actually in what has been a difficult market to be in. DFA has actually eked out a positive return here for the quarter at a positive 0.64, but the index is negative 6.97, and they rank in the top quartile versus their peers. And if you look at them over the 1 year, the 3 year, the 5 year time periods, 10-year time periods, they have beat the index in all of these time periods and just slightly below in the since inception, and have had mixed performance versus other emerging markets equity managers. Now, Invesco has had a bit of a tougher time. And I mentioned to you a few minutes ago that, and in our past presentations, they did have about an, I want to say 9% exposure to some of the stocks in the Russia-Ukraine situation. They've had to write them down, and you're seeing that reflected in not only their quarter returns, but their 1 year numbers. As you can see here, significant underperformance versus the index, and their ranking, they're in the bottom quartile. And this is hurting their long-term numbers. Their since inception number is still somewhat weak, 3.56 versus 4.15, and they're still not ranking well. So that's a manager that we will continue to look at for improvement or to make some type of change. Exponence, which you hired in 2020 to manage a managers program, as you can see here, versus the MSCI World. They actually are slightly under, but they rank well at 37th. And since inception, this managers program has delivered since September of 2020. This manager has delivered a 16% return and ranks 45th. And these are the sub-managers within that managers program. And you'll see a bit of a change here when Jeff goes over the April flash report. Moving on to page 26, if there are no questions regarding international and emerging, we'll go on to fixed income. In the fixed income segment, you can see here you've got 3 managers. 2 are your traditional core managers, Manulife and Ernest Partners. And if you look at Ernest Partners and Manulife in what was a negative market for fixed income, they also protected on the downside and did deliver performance on a relative basis better than the Bloomberg aggregate. Manulife at a negative 5.68 and ranked better than the average manager at 34th. Ernest Partners for the quarter, negative 5.72, ranking 38, also better. If you look at the long-term returns for Manulife, you will see Manulife has added value over and above the benchmark in all the time periods measured. And since inception, return of 6.67 and ranking at the top of their peer group during that time period. Ernest Partners, the numbers are not quite as strong, but still, they're holding their own. As you can see here, the 1 year number, the 3 year number, the 5 year number, and all the numbers, they're ahead of the index, but just not ranking quite as strongly as Manulife. But the since inception number, they're still above the median manager in that peer group. Exponence is a bit of a different type of manager. They have a different way of managing as well as the types of bonds that they will buy into. And either you're going to see a lot of volatility there. Either they're doing really, really well, or they're doing very poorly. And as you can see here for the first quarter, the return is a negative 11.52 versus the ag at negative 5.93. But there are a lot of bonds that are within their portfolio that are not part of the Bloomberg Aggregate Index. But I will turn your attention to, since inception, this manager has delivered since 2015 positive returns over and above the Bloomberg Barclays Aggregate, and ranked 6th. Do you want to, Jeff, do we want to come in now and talk about the change regarding the portfolio manager exponents and fixed income?
Sure. It's probably a good time to go over that. So we were informed by Exponents that the primary portfolio manager for this product, Randy Lessick, has retired, and I think only time will tell as we continue to have discussions with the manager what that actually entailed. I guess generally when we in the market, when we see somebody retire, it's usually you get a long lead time on that. So someone tells you 12 months out that they're preparing for somebody's retirement, and there's a team that's going to be in place that will eventually transition. So this kind of came up on us pretty quick. So certainly we weren't able to get much more information out of the firm on that, other than that it was a retirement. So we kind of have to leave it where it's at, and I don't know how much we can read into it at this point, other than we do have some concerns on this, in that Gwelda and I spent a good amount of time in a meeting with Charles and Randy and the team to go over this portfolio, and essentially went through a lot of the holdings in the portfolio, the structure, the strategy, how it's managed. And at that time, Randy was the guy that was doing all the talking. So he clearly was the one on the call out of the three or four individuals that were on that call from Exponents, that it seemed like he really knew the portfolio and was probably involved in the day-to-day management. So again, that's not to say that the team that remains doesn't have the experience to manage, but I think from our standpoint, it gives us pause to, number one, say we do need to place the manager on watch. But also, if everyone recalls, as of at the last meeting, we had a recommendation to actually increase the allocation of this manager. So just based on this retirement, and we're evaluating, and that this manager will be on watch, we do want to recommend holding off on adding any additional money to Exponents fixed income at this time. So Sue, I don't know, do you want to pull up the chart, and we can just talk about the plan on what we would recommend?
Okay. So you want the new one, Jeff?
Correct.
Okay.
Perfect. Okay, so again, we know there's a lot of numbers on this page, so I'm going to try and keep this really simple, in that in all of the categories. So all the way to the right, that's the column which is the recommended policy that we recommended at the last meeting. So none of those policy targets have changed. So those all remain the same. But if you focus on the section, the three highlighted orange-red managers under fixed income, the Exponents, Loomis, and Neuberger, all of those we have categorized in a similar style and risk bucket. So we had those targeted at 3% each. And we are going to recommend to keep that long-term target for exponents at 3% as we evaluate. And certainly if we go through time and our opinion, if our opinion changes that we don't think things are going to continue to be good, or if we have major concerns, we can readdress that target. But as of now, we'll keep the target, but for the short term, we would not recommend adding the additional capital. So if everybody can see here that there's now a 0 in that column for adding money. And so their relative allocation stays about the same as where it is today. And the Loomis and Newburger portfolios, you see that we're still recommending pulling those down, but not as much as we had originally targeted. So we had targeted having those closer to 3% and then have exponents at 3%. Well, since we're not going to add the exponents, we would not pull those down as much. So we're still pulling Loomis down by about 14 million and still pulling Newburger down by about 7. Now, just to give everybody compare and contrast from what we had recommended at the last meeting. So we had recommended adding 13 million to exponents. So now that's 0. We had recommended reducing Loomis by 20 million. So now we're reducing them by only 14 million. And then we had recommended reducing Newburger by 15 million. And so now we're only reducing by 7. So with respect to, again, policy targets, they're all the same. So none of that changes. And then with respect to the ranges, all of these allocations are still within a tolerable range. So even by not adding money here and by not pulling Loomis and Newburger back as much, we're still in compliance with the recommended policy targets. So these would be what we would really consider just a minor revision to what we had recommended. But again, in recognition that for exponents, we really need to give them a few quarters to understand if that portfolio is going to continue to be effectively managed by the remaining team here.
So we would need 2 motions, one, the revised reallocation, and then also the placing of exponents on watch due to portfolio manager departure.
Hi, Guelda, this is Christina. I just joined. Sorry, I just landed. I agree with your assessment and the changes. I'm at an airport, so I don't have the ability to speak much. Just listen.
Okay.
For background noise, but if there's anyone that Sue can bring up the motions and then we can proceed.
Yep, I will do that. And just FYI, we're having a pretty good storm move through here in St. Louis. So hopefully all is well and we keep our power and all that good stuff. But and hope everybody is safe that's here in St. Louis.
Okay.
I think there's tornado warnings in the area. So.
Oh my goodness.
Yeah.
Well, my flight's not till, I'm in Chicago. My flight's not till 8:46. So I'm hoping I can get home tonight because it's been one hell of a day.
Oh, wow.
Yeah, I think you'll be good, Christina. It should be good.
Okay.
Right now. So I just had the one motion for the rebalancing. I didn't do for the watch list though.
So I'd like to make a motion to approve the revised balancing movements as recommended by AIMCO, our investment consultant. Is there a second?
Goodwin, second.
Is there any discussion? Hearing none, Sue, can we get a roll call?
Angela Banks,
Yes.
Christina Bennett,
Yes.
Louis Cross, Louis is still there. All right, Sheila Goodwin,
Yes.
Donna Jones,
Yes.
Martel Mann,
Yes.
Bobby had to drop. Albert Sanders, Justin Stein,
Yes.
okay, and Doris Walker.
Yes.
All right, so we have 7, the motion carries.
So can I get, I'd like to make a motion to add exponents to watch list due to portfolio management change per
Second.
ANCO's recommendations. Thank you. Is there any discussion? Sue, can I get a roll call?
Yeah, and I'm sorry, who did the second?
I did.
Doris.
Oh, Doris. Okay, thank you. Angela Banks,
Yes.
Christina Bennett,
Yes.
Lois Cross, Sheila Goodwin,
Yes.
Donna Jones,
Yes.
Martell Mann,
Yes.
Bobby Richardson, Albert Sanders, and Justin Stein,
Yes.
Doris Walker.
Yes.
All right, so again, we have 7, the motion carries.
And bring back up the performance report.
Okay.
And where it should be on page 26. Okay. All right, so we finished up with the core fixed income portion, and the next one is a Loomis Sales Strategic Alpha Trust. As you can see here, this Loomis Sales Alpha Trust underperformed in the first quarter of the year with a return of negative 4.30 versus the LIBOR plus 3% at 0.68. As you can see, it's been challenged. This was brought on in 2017, has added value of 3.32, but not kept up with its benchmark there of 3.32, and is ranking in the 3rd quartile in their peer group. The TIPS index, this is what we basically buying a index fund to mirror TIPS in Treasury Inflation Protection Securities. And it's right in line with its index, but slightly below the other active TIPS managers. If you look at the 1-year number, this is brought on 2019. As you can see, the 1-year number, it's right on top of it, and it's ranking better than the average manager that actively manages, and the long-term return also. So that's a good use of money in using an index fund to manage this portion of the portfolio. If you turn over to the next page, Sue, which is page 27, we've got, not 27, I'm sorry, I keep going, 28. All right. This is the rest of the portfolio. You've got at the top, Newberger and Berman, which is your opportunistic fixed income manager. In the first quarter, underperforming the LIBOR at negative 4.8 versus 0.68. The longer term numbers are somewhat challenged as well compared to the index as well as versus their peer group. The next manager is emerging market debt manager, Lazard. Actually, in a very difficult market for emerging market debt, as you can see here, they're protected on the downside with a return of a negative 3.93 and rank very well in the peer group at 13. If you look at the index that they're benched against, it was down almost double that at negative 6.13. If you look at the longer term numbers, this manager is outperforming in a couple of the periods. I think that's the 1 year and 3 year period. They've outperformed and ranked well. The since inception number, albeit they had delivered 3% of return, they are not ranking as well and have not kept up with the index on the since inception, which is 2016. We have two managers here in the global asset allocation. As you know from our recommendations of prior meetings, we're looking at eliminating one of these. As you can see here, GMO, which is a manager that we're recommending to use for liquidation as well as use for funding benefit payments and expenses going forward. They have underperformed in the quarter at a negative 6.47, ranked 80th. And if you look at the longer term numbers for this manager, they have not kept up with their index and they're in the bottom quartile versus their peer group. The PIMCO All Asset Fund, which is the one we are recommending to keep, albeit a negative market, they actually protected with a negative 1.95 versus the index a negative 5.47, ranked above the median at 28th. And if you look at the longer term numbers here, with the exception of the furthest period out, this manager, albeit have not kept up with the peer group long term, in most periods they have, but they've added value over and above the index since inception. And then the next section is hedge funds. Actually, your hedge fund managers, with the exception of Grosvenor, had a pretty good quarter. Entrust, as you can see here, had a return here of 0.48%. She's negative 0.48% versus a negative return for the hedge funds, fund of funds composite index at a negative 2.73. So they protected in what was a very difficult market. That's as a negative 0.48, I'm sorry, versus negative 2.73, protected even on the longer term basis versus this hedge fund of funds composite index. Whitebox, which is your best performing hedge fund, it's a multi-strat manager, actually delivered nice positive numbers at 5.5 versus the index at 1.76. And as you can see here, this manager through all time periods measured here has added value over and above their respective index. Grosvenor had a difficult quarter with a negative return of negative 5.47 versus a negative 2.73. But if you look at this manager on a longer term basis, for every other time period measured, they have exceeded the return of the composite index. So they're having some short-term weakness here. Next page. We did get some returns in for real estate. As you can see here, the Trumbull Fund, which has been a difficult, and I know we were talking about putting in a redemption request for the property fund. Actually, for the quarter, that is 7.39% return. I actually listened in on a call with them yesterday, and they delivered returns over and above the Medcube Odyssey at 7.39 versus 7.17 and ranked 30th. As I talked about, the longer term returns have been challenging, but as you can see over the past year, even with the challenge performance, they still delivered over the 1 year period 23.3% return. And on a long-term basis, you've had them for quite some time, since 2004, 7.4 versus 7.6 for that fund. I'm seeing, it looks like they're coming back, but it's going to be a long road back. The Trumbull Property Income Fund, which has a debt component in it, didn't do quite as well this quarter, delivered positive numbers, but not as strong as the property fund, which is more of a core fund. As you see here, the returns for the property income fund, 4.56 versus the Odyssey, NCREIF Odyssey at 7.17. And the longer term returns aren't quite as compelling as the on a comparative basis. This since inception number, you have them, they've been with you a very, very long time. And since 1991, they have exceeded the Odyssey with a return of 8.69 versus 6.94. Now, these other two real estate managers, we have not received returns yet for them for the quarters, so they're showing 0. So disregard these universe rankings because we just have not received the returns yet for them. And the private markets, we are still awaiting the return calculations for them, so we don't have those at this time either. Any questions before we move over to the watch list, and I'll outline the changes that we have seen since the last reporting period, quarterly reporting period. Okay, if not, Sue, if you can turn to page 83, it's near the back of the report. Did I go too far? Oh, let's see. Okay, here it is. Okay, so on this page, the only changes from the last report is you will see here systematic. Systematic was not on the watch list for last time. They have slipped into that due to performance. So that's one change from the December report where we're recommending them from the watch list. The other change is Causeway was on the watch list last time, and their returns have brought them up to where they're no longer qualify as watch. And then we already have voted on, not for return reasons for Exponence, but because of the departure of the portfolio manager, Exponence fixed income has been recommended for watch.
Walter, could you give us an update on the notification of the minority brokerage program and results from that?
Yeah, I talked about that a little bit earlier, but we can go back to that. If you want to go back to that page, let me see, what page was that? That was on page 16, I believe. Okay, yeah. Okay, so as I mentioned in the earlier conversation, in the domestic equity segment, Edgar Lomax, Systematic, and Westfield have all met the 33% return goal year to date for minority, women, disabled businesses, enterprises in domestic equity. We did receive communications back from Intech and from TCW. Intech basically, the managers that they have on their list that they utilize are not necessarily the minority managers that we have on our list. They have allocated dollars to a minority broker, Guzman and Company, through January through March of this year, represent 15% of the total commission dollars. But they, the managers that we have on the list have not met, I guess, their standards. And they did send out a letter to a letter as well as a report outlining their brokerage policies. That was Intech's response. And TCW also sent out a response back to Sue, and they said that the trading desk most likely, trading activity in your account would not meet the minimum 33.13. They do a lot of their trading through block trades, and as a result, the total commission dollars would probably not they would not be allocating to the minority brokers with that block trading. The step outs would not meet the minimum 33.3% of total commission dollars MWDBE managers. So those were the two negative responses, I guess you would say, as far as that's concerned. And this is for managers pretty much that are all separate account managers. As you can see, Causeway did meet in the international section. The goal is 10%. They've done 29%. In fixed income, Exponence and Earnest Partners have all exceeded that 10% goal. And in global equity, Exponence succeeded the 10% goal at 23%. So it still sounds like this has been an issue with TCW before, and they continue to basically say that their block trading would not meet the MWDBE goals of the fund.
Do they do business in Illinois?
I don't know what their client base is. I don't know. I can't really speak to that.
'Cause if they've known our policy, and I don't know how the rest of the board feels, but to say that they're not going to comply with something that they have known for years they had to do, to me is offensive. When, if you can provide us with any alternatives, but to have two managers say they're not going to meet our guidelines, to me is not acceptable. But I'd like to hear from the rest of the committee. Is Lewis on the call?
I think he dropped off. I haven't heard from him, so hopefully all is well, but he dropped.
This is Angie. He sent me a text. He's in his basement and said he'll return it around 5:45. And Christina, I do agree with you.
Yeah, we've had to threaten them in the past, and they complied in the past. So the fact that maybe it's new management or new portfolio manager, but I doubt that given the size of their firm, that they don't do business in New York or Chicago or Illinois. And I mean, Golda, maybe that's a question to ask, but granted, I know we're smaller, but if they're not willing to comply and they're saying they're not going to, then what's our alternatives for this space? If you have any recommendations.
Yeah, Gwilda, correct me if I'm wrong or if you have different opinions, but I have a couple of thoughts. And then first is Intech, and we already know they're sort of on the bubble, and that's one thing you can sort of you can throw into that list for Intech to say, well, they're on a performance watch right now, and they're also on an organizational watch because of a lot of changes. And now the brokerage thing as well probably gives us enough ammunition to say we can look to replace them. So is there a replacement that we could find that will comply with something like that? There certainly is, because we can do a search, and as part of our search we can say you must any manager that we want to consider in this search must comply with this requirement, and so we'll bring them in. They have to comply, and if they're not going to, then they'll be shown the door. So that's Intech. Now TCW, again, it hasn't been on a watch for any other reason. So as far as the our table in the back and those qualifications, they're still passing, but their performance hasn't been great lately. So we could sort of soft watch them on a performance factor, and then also throw into the mix again that they're not complying with a policy that was outlaid to them a long time ago. So I guess, again, we can throw all that into the mix, and if the decision of the board is we want to move on from them, again, I don't think it's going to be a challenge for us to do a search for a replacement that, again, will make it very clear in the search that they have to comply.
I agree with Jeff on that, on both those points.
Now, I guess the second comment I would make is if the board's history and recollection is that TCW used to comply with this, I mean, Intech, I'm not sure that's just not worth pushing on, number one, because that's not that's not our favorite manager to begin with. Number one. Number two, we know because it's a quant deal and how they trade that's just going to be a struggle for them, period, to try and comply with something like this. But TCW, if everyone's recollection is that they used to do this, then it possibly, I know we sent them a letter, but maybe Gwilda and I can get them on the phone and just, because we don't know who looked at the letter and responded and looked at it, but we can walk them through the history and just say, hey, this seems like it's a no-brainer and why you can't do this. So maybe we can give them that last opportunity via an actual conference call. But again, and if we get pushback, then that's just another factor to throw this manager on watch and consider a replacement.
I
I
think,
agree. And they did comply in the past, and we did, irrespective of performance, we did fire Causeway in the past. And NEPC went and spoke to them and they agreed they would continue going forward. So this board has made that decision that irrespective of performance, this is something that we stand by.
And that can also be part of that conversation that we have with TCW, just to say, listen, you're sort of on a soft watch at this point for performance reasons. And now based on your response to the brokerage requirement, they are ready to fire you. And that could light a fire.
We can make that call prior to the next meeting and get their response.
Yeah, I would appreciate it. And I hope that others on the board as well. It never hurts to make that phone call.
Okay. And
I have-
I think, Sue, you might want to, I know they sent email, share that email with the committee.
I
that
will.
TCW sent out.
Yeah. So do we want to do a motion for Intac?
Oh my God.
We can do a motion if we want, if it's better for you, see. Walter, what are your thoughts?
I think collectively, because their performance isn't the best, they have organizational issues that we outlined in an earlier meeting, and now them not being able to comply with the brokerage, I think we can put them on watch, or we recommend putting them on watch for those collective three things. So it's not just a one thing. And they're talking about the Guzman, but Guzman is not a firm that is on the list that St. Louis Public Schools has supplied for them for the brokers.
Christina, just to clarify, were you suggesting a motion for watch, or were you suggesting a motion to replace?
Motion for watch.
Yes,
And again, that minority brokerage list that we have is, it's been from experience. However, if the person they're using is a minority firm,
Mhm.
then I have no problem with that, right? Because it's a minority firm. We just want them to make the trades.
Okay. Well, they
With
said
a
they
minority
are
firm.
trading with Guzman and Company as a minority brokerage firm that meets their standards, and they have traded from January to March at 15%. It's below the 30%, but they are trading with a minority firm.
Yeah, as long as they can trade with a minority firm and meet the guideline, then I that's totally fine.
Okay. So, do you want to just hold on that recommendation for watch to see how they do? If they increase their percentages, or do you want us to put them on watch anyway? Because there's two other reasons. There's performance as well as the change in organization.
Yeah, I recommend we put them on watch.
Okay.
Once they see it, if they get notified they're on watch, then that's even better. And it's the three-legged stool instead of two.
Okay.
And I make a recommendation that we add Intech to the watch list based on performance management and now minority brokerage. Is there a second? Doris, a second. Is there any discussion?
I
Hearing
have
none,
some,
Steve?
I have some discussion.
Okay, hey, Louis.
Hey, how you doing, Kristen?
Good.
I just want to make sure that we're going in the right direction with this in terms of, instead of putting them on a list, a watch list, should we replace? And can you all, Jeff and give me some more pointers to justify doing watch instead of replace? What do you all see that is in the future that tells you that a watch might make them turn around? That's what I needed to know from you all.
Yeah, well, I think for TCW, the watch would be number one, because our actual our matrix that we use that we put in this report doesn't technically show them on performance watch yet, but their performance as of late hasn't been great. So I suspect they could be making the matrix soon if things keep going in the wrong direction. Number one. Now, number two for TCW is that given their strategy that it's not quantitative, it doesn't go through block trading, and I think they have a lot more discretion on how they allocate their commissions, that we could have a conversation with them that just says, listen, we think it's pretty easy for you to comply here, do it. So I'd say we could give them that benefit. Intech, on the other hand, I think is a little bit tricky, because I think if we should have that same conversation with Intech, and we will, but I think the answer we're going to get is that because we're quantitative, because we do a lot of program and block trades, and those systems work differently with respect to how they allocate trades, and because that system is a lot more dependent on sometimes getting extremely low commissions from wherever they can get them as part of their process to add value, that they're probably more apt to come back and just say we can't force, we're going to trade with the de Guzman, we have them on the list, but our system will never force 33% out of that program. So I think they're going to be a little bit more challenging. But again, let us go back to them and have, because the same thing, we might have just got a canned response from them and to that letter. It might have gone to a compliance department, but if we can talk to an actual relationship manager, and again, make it clear to them that this could be a deal breaker, and the board is ready to act, then maybe we get a different story. But I think we might not get a different answer from Intech. I think we can get a different answer from TCW.
Yeah, and the performance is, they've got another knock against them also. Intech does.
Well, they've got a couple, not only performance, but they've also
changed
organizational issues as well. So
right.
Okay, that was my concern. That's what I heard, and I know Chris is and Martell and Al are the experts on that committee, but I just felt like they just sounded kind of weak. And why would we give them put them on a watch list when we might need to just replace them? Because we don't want to keep waste another month and find out that they're still going down the tubes. So Chris, you and Martell and Al, whatever you all suggest, I'm for. I have concerns about this particular company.
Yeah, and Louis, they're valid concerns, and that doesn't stop us from having ANCO start looking in the background for a replacement.
Okay.
If we have to pull the trigger. So
I'm
that's
with you.
we just have
I'm
to
with you,
give them
Chris,
direction.
Martell, and
right.
Al. I'm with you all. I just want to let you all know, because I'll pull the trigger in a minute.
So, all right. Any further discussion? Hearing none, so can I get a roll call?
Angela Banks,
She might be down in the basement because we had tornado warnings in our area. So,
yeah.
but I'm back.
Okay. Christina Bennett,
Yes.
Louis Cross,
Yes.
Sheila Goodwin,
Yes.
Donna Jones,
Yes.
Martell Mann. I think he dropped off due to power issues. So I didn't know he was back. Justin Stein,
I think he had to leave at 5:15. So
okay, and Doris Walker.
Yes.
Okay.
Angie, yes.
Oh, Angie, you're back. Okay. Thank you. So we have 6, the motion carries.
So Gwilda, if you can start looking in the background for a potential replacement or search.
Okay, we will go ahead and put
That would be-
forth large cap growth search.
Okay. Thank you.
Are there any more discussions on the performance, the watch list, brokerage, before we wrap it up with the April update on your performance? Okay. Jeff?
Okay, Sue, do you want to bring up the April flash? And I'm gonna be sensitive to everybody's eyes glazing over at this point, because I know we've been going at it for a while and look at a lot of numbers. So I will keep it short and sweet. So Sue, if you want to back up a couple of pages. Great, thank you. Right here. So again, lot of numbers. Not going to spend a lot of time here, but I think what we want to talk about is at least some of the trends that Gwelda had talked about with the managers. Some of those had continued, and if you recall back to when we talked about the economic environment and market overview at the end of the quarter, and we had that 1 year chart that still had some nice positive returns. We'll now take a look at the 1 year here, just because of what we saw in April really knocked down a lot of those 1 year numbers. But certainly a couple things that do stand out. Again, we talk about those trends, and these are things that you're going to see in the April numbers that were favorable for the portfolio. But you'll see Russell 1000 Value Index for both the month, and then go out to the 1 year where that's still positive. So again, a reversal of that value versus growth. So go back the prior 2 years and going through COVID, where growth was doing very well relative to value. A lot of that has reversed, and you can even see that in that top chart all the way to the right. That shows us all of the different segments of large, mid, and small, and then value and growth. And just focusing on large cap, you can see the value and growth now for where it was in 2021, growth still leading, but now take a look at where we are in year to date for value versus growth in large cap. So still negative, but not by as much as those growth stocks. And that really holds true whether it's a mid cap stock. So you see in the middle down 7.7 relative to growth down -22. And then on the small cap, again, small caps in general have been out of favor, but the value is doing much better than the growths. So again, a little bit more of reversal of trend. If you go back to that top table to the left, and all the way to the bottom of that is the MSCI EM, and that's the emerging markets. So still down for the month, but trending a little bit better than other things. So again, it's been very much out of favor, and we're starting to see selectively everyone coming back into the market. So a couple of other just data points to look at. If you go to the third table down from the top on the left, those are interest rates. And again, I talked about before some of these things that are starting to impact consumers and businesses and everything else. Look at the bank rate 30-year mortgage rate. So if you look at where that was at the end of April at 5.4% relative to where that was at the end of the year, 3.2%. So that's a pretty significant increase. And again, that being due to the path that the Fed is on with interest rates and where the overall market is pricing interest rates right now. So again, think about how it's been a lot more affordable over the past couple of years for people to buy houses because those interest rates were low. Well, that is starting to trend in a different direction. So again, another thing to point to, if we look at the two tables on the right and the one all the way at the bottom, those are the different commodities. And so we looked at a lot of negative numbers and say a lot of things aren't working. What has actually been working and getting a positive return? Well, oil has. So that's both a positive and a negative, because that oil price, if you're just speculating and buying oil futures and oil related stocks, well, you're doing pretty well, but the rest of the market and the consumer, that actually hurts, because the higher that oil price, that's going into gasoline prices, where again, you can see there's been a pretty big jump since the end of last year. All of those things continuing to hit the consumer. But again, think about, again, everybody says, well, oil's been doing really well, and how do we take advantage of something like that? Well, you do, because you have active investment managers in the US and outside of the US that are buying oil services stocks that are doing well in this type of market. And your hedge fund managers are also doing certain things within that market that are either directly taking advantage of the oil price spike, or again, investing in service-related companies that have that exposure. So again, with the portfolio isn't overloaded with it because we know that it's volatile. We know oil prices can jump around quite a bit, and those commodity prices can jump around quite a bit. But when you have a very good, well-diversified portfolio and managers that are well-diversified within, you will be reaping some of the benefit for it. Again, hard to see when we have these big negative periods, but there are these mechanisms in place and exposures here that are limiting some of that downside because we have those exposures. So next page, Sue. So again, from the asset allocation standpoint, you can see that these are not going to be major changes from what Gwelda shared with you at the quarterly report. The one thing that you will note is it's the unfortunate way to rebalance it. If you recall, the large cap as at the end of the quarter was slightly just above that tolerable range. Well, that's now within our tolerable range, and the markets did that to us. We don't like to rebalance that way. Again, think about this chart in relation to what we also just recommended, in that some of these little targets and these ranges, if all of those changes get approved by full board, that will update this table and we'll see some of those sort of move, but also by the process that we recommended some new targets, ranges, and rebalancing to those ranges. Once those are approved, this chart will look like everything sort of tightened up quite a bit more. So anything that's been out of whack on this page, again, while we're still in compliance, because we've now had a recommended rebalancing, we'd start to see a lot of those triangles come back to the middle of all those ranges. So again, from a compliance standpoint, we're still in compliance with this policy and in the recommendations that were made and again approved for what we adjusted today. All of those recommendations still hold for us. Next page, Sue. Okay, and so I'll kind of end here. I don't think we're going to delve into a lot of different managers, but again, we can see the month, the return was negative to about 4.3%, a little bit ahead of the index. And again, recall what we talked about on that value versus growth. And so where we are ahead of the index for the month, it's really going to be due to those pockets of things that have trended a little better for us and have reversed course. So the value exposure in the portfolio, and you can see it on this page, it's Lomax, and then some of the other managers on the next couple of pages that have more of that value orientation have done well for the portfolio, and again have helped to limit that return relative to the overall policy index. The small cap managers in the portfolio relatively have done well. The global equity manager, again, while negative, Exponents has done a really good job. They're down less than the market. And so a lot of those numbers are factoring into, or starting to factor into the longer term numbers. And again, the objective here is tightening up that gap. And that's what we want to continue to see over the longer term, that we're tightening up that relative performance gap. And you can see from the 10-year period, just slightly ahead of that number. And again, as we take a look at these portfolio changes that we talked about, the objective there, tightening that gap, having longer term performance that outperforms and starting to look better relative to universes. And again, we'll continue to track those on the quarterly basis and quarterly reports, but that's really the objective and what we would expect with some of these changes on a policy basis and manager basis that we've recommended over the past couple of meetings. So I will stop there and take any questions, and hopefully everybody's still safe. And
No.
Lewis, glad you're out of your basement, and I'm gonna have to pop up the radar and see if that's coming up my way. So.
Yeah, Interstate 55 at Lindbergh in St. Louis is flooded, and it's going. It's above the tires on the 18-wheelers.
Oh,
Oh my goodness.
So cars are floating away. So it's pretty bad.
oh,
Wow.
Mhm. Yeah.
Christina, you maybe
thank
need to
you.
stay where you are, Christina.
Yeah. I mean, that we had warnings from 5:15 to 5:45, but we're clear now, so we're okay.
Christine, is your flight still showing on time?
They just moved our gate. I haven't looked. I haven't moved since I've been here, sitting here. But my flight's still 8:46, so maybe it'll have passed by then.
Yeah, you could have some time.
Yeah, I've just been up since midnight.
Oh, yeah.
No, well, I don't know.
You're
What time is it
tired.
now?
You're tired.
Right, yeah,
I
yeah.
get it.
Yeah. You be safe, Chris.
Yes, please.
Yeah. I'm 7 hours ahead. I'm 7 hours ahead. So it is in the wee hour. What time is it's midnight? My internal clock is midnight right now. So yeah. So I'm gonna take. What was I thinking? Thinking I'm gonna work tomorrow, full day. But hearing no other questions, do we have anything else for ANCO today?
No, that's it from us.
Jeff, did you want to just real quick mention that conference that we sent out to the trustees?
Oh, sure, good. Sue, did you get a chance to send
Yeah,
that out to everyone?
I sent that
Okay,
to
so-
everybody, yeah.
Yeah, so the National Public Pension Fund Association, it's fairly new, and it was started by a group here in Chicago, but has slowly expanded to a nationwide basis. And it's a really nice setup for a conference in that their intention is to keep it more of a roundtable and to keep it intimate and not to have a big, I know you've all been to conferences before, and some of them can be a real boondoggle where you have several days of classes, events, and exhibiting halls, and you go there and you probably spend most of your time fighting off managers and service providers and people that are trying to sell you stuff. And this is the intention here is to really not have that, and it's to bring together trustees and executives of plans and to just allow them time to speak to each other and then have some important roundtable discussions. And I don't know what the requirements are in Missouri offhand for your continuing education, but certainly if there is a requirement, this is also could be an event that checks that box. So I just wanted to make everybody aware of that, the dates. The other thing to note on that is if you did want to come up, that NPPFA covers the room and the meals at the events and everything like that. So you'd really only be responsible for getting up there.
Okay.
When
Sounds
is
good.
it?
August.
Give me one second.
August 7th, isn't it? 7th?
Yes,
Right,
7
August
through
7th.
9. Right.
Right.
And it's in Chicago?
It's in Lake Geneva, Wisconsin.
Oh, Wisconsin. So the only thing is that this is not an approved conference per our guidelines. So we would have to get a motion to approve so that if anybody who wanted to attend could attend. Correct, Sue?
That is correct, yeah. I mean, there is minimal cost, but yes, it is not one of the approved conferences.
Let's
So
see.
can we get a motion just in case anybody wants to attend? Just so
Well-
that we don't exclude somebody.
Yeah. I like- Go ahead. Go ahead, Sheila.
That should be done in a general meeting.
Yes, that is correct, Sheila. You are correct.
Yeah.
Okay, we have a meeting in June, right, Sue?
Yeah, June 20th. I mean, typically what we do here at the investment committee, gets approved by the trustees. So, I mean, we can have a recommendation here from the investment committee, and then it would be done again at the June meeting.
Okay, well, why don't we do that? Is that okay, Sue and Martell and Al? Sheila? I guess so.
I think Martell lost power, so he's
Okay,
he's
I'd
not.
like to make a motion that we could approve attendance at the Lake Geneva, Wisconsin Convention. And what was the name of it again, Jeff?
National Public Pension Fund Association.
Of the National Public Pension Association. Could I get a second? Okay.
Second.
Do we do a roll call, Sue?
Yes, if there's no discussion, Angela Banks,
Yes.
Christina Bennett,
Yes.
Louis Cross,
Yes.
Sheila Goodwin,
Yes.
Donna Jones,
Yes.
Justin's gone, and Doris Walker.
Yes.
All right. So again, we have 6, so the motion carries, and again, we'll bring this to the full board in June.
Okay. Well, great. Hope it works out. And if some are able to come up, great. And Sue, just keep me posted if we do have anyone coming up, just so I can give everybody a heads up at the organization.
Okay, will do.
If there's no further business for this evening, can I get a motion to adjourn?
I'd like to make a motion that we adjourn the investment committee meeting for May the 19th, 2022.
All those in favor, please say aye.
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 And was there a second?
Was there a second?
Christina, second.
Okay, great.
Thank you, everyone.
All
Thank
right.
you, everybody.
Okay.
Y'all stay
Okay, thank you
safe.
all.
Everybody
Okay.
stay
Right.
safe.
Yeah.
Okay, bye-bye.
Bye-bye.
All right, bye-bye.